Hey everyone, this is Tatiani Favors, your tax business coach. And this week we will discuss due diligence and the tax professional, which is you. Okay, and so when we are discussing due diligence as it pertains to the tax professional, we are referencing all of the refundable credits and the head of household filing status. The refundable credits being the earned income tax credit, child tax credit, additional child tax credit, credit for other dependents, and the American Opportunity Tax Credit. And so, why is this important? Just to give you some background about how this came to be, each year, tax preparers complete more than half the Form 1040 returns claiming the refundable credits and or the head of household filing status. So this means that we all of us tax professionals, we play a key role in ensuring that our clients are correctly claiming these credits and the right filing status. And so the real reason why this is important and why this is a huge issue is that the IRS estimates that 1 in 4 EIC claims are incorrect. And so this results in billions of dollars paid out of error each year for the earned income tax credit alone. And so that's why the IRS thinks that this is such a huge deal because each year they are paying out billions of dollars that is in error. And so in an effort to minimize the amount of money that the IRS pays out and to also minimize the amount of fraudulent activity, the IRS has come up with 4 due diligence requirements for all tax practitioners to follow. Requirement 1 being you must complete and submit Form 8867, which is the paid preparers due diligence checklist. Okay, Form 8867, it really helps to ensure that you consider all the due diligence requirements for each return you prepare. It's similar to a checks and balances to make sure that you have all of the worksheets and things that accompany this form. Requirement 2, you must complete the worksheets and compute the credit. You want to complete all applicable IRS worksheets for these refundable credits. And you also want to make sure that you are recording the computation of the credits that you have claimed on the return. You want to make sure that you record this and save all of the worksheets and equivalent documents to show, if you need to, and of course in the event of an audit, how you computed the credit. The great thing is with these worksheets and all of those type of things, the software professional tax software typically knows if you have a due diligence worksheet or if you are claiming a certain refundable credit or the head of household filing status, what worksheets are necessary and required to accompany this filing. That's with professional tax software, not the TurboTaxes, not any of those, but typically your professional softwares will have those worksheets there for you, and they will also retain the copies that you need. But you also want to make sure you're taking the additional step to follow these requirements. And I'll tell you why in a minute. Requirement 3, knowledge. Okay, you guys, you must not know or have reason to know that any information you use to determine your client's eligibility to claim these credits is incorrect. Okay, you can't ignore any implications, and you must make reasonable inquiries that a person will make if something seems incorrect or inconsistent that your client is telling you. And of course, you must document either via paper or electronic files any additional questions that you asked the client and also what their response was at the time when you have interviewed them. So in layman's terms, you can know think, have anyone think that you may know about any inconsistencies that are happening with your client. You cannot, essentially, what I'm saying is, don't do not file a client's tax return as eligible if they are not. That is illegal. You will get fined and banned from preparing taxes for compensation. You definitely do not want to do that. And requirement number 4 is keeping records. Of course, you want to keep a copy of Form 8867 and all the applicable worksheets. However, you also want to keep a record from whom the information you use to complete the return, who you obtained it from, and any additional questions that you've asked during the interview. You want to keep these documents for 3 years, and you want to file them either in a paper or electronic format. I have definitely moved forward to a more electronic format. It's actually a cloud-based secure platform that I use. I like to call it my filing cabinet in the cloud. Because it's essentially that it holds all of my clients' information, not only their final tax return, but all of their documents, their identifying documents, any additional notes that I put in there. I have it all electronically. I do not keep anything paper anymore. And I highly suggest that you all, if you have not already, move forward to utilizing a more electronic solution. And so let's move forward and talk about how employers may be penalized for employees' failure to exercise due diligence. So if you own a tax business and you have independent contractors or employees working up under you, listen up, because you can be penalized if any of the following apply. If you participate either prior to the time or when the return is filed and you knew of the failure to meet the due diligence requirements, or if your firm has failed to establish reasonable and appropriate solutions to ensure compliance, or if your firm simply disregards its reasonable and appropriate compliance procedures, okay, through willfulness, recklessness, or gross indifference in the tax preparation of claiming this credit for a refund. Simply just ignoring facts that one of your workers are doing will cause you as the employer to be responsible for the fines that that employee has incurred by not meeting the due diligence requirements. And so we don't want that. We definitely do not want that in any capacity. So let's take a look at some steps that you can take if you are an employer to establish reasonable and appropriate procedures. And so you can review your current office procedures to ensure that they address all appropriate due diligence requirements, okay? Because due diligence, they are rather new in the last few years. They have added the head of household filing status in the last few years. So you want to make sure annually that you are always checking up on your current procedures. You want to review your procedures with your employees and or your team to make sure that they clearly understand what their responsibilities are and what your expectations are of them. You would want to also conduct annual due diligence training and recommend your staff to complete the online module that the IRS offers. And also just test their knowledge and your procedures to make sure that they are retaining the information as they should. You want to also perform recurring quality review checks on your employees' work, including but not limited to the credit computations, documents reviewed, the different records kept, and you always want to ensure that all records are properly maintained. Because if you do not, or you are just an independent tax practitioner, it can result in a penalty of $530 per failure per tax return filed in 2020. Each year, this penalty increases, and for 2020, the penalty is $530 per failure. And so these failures can also result in audit, suspension, or termination of e-filing privileges, which we do not want to do that. So let's look at an example and make it real, guys. And so let's say the IRS finds 5 returns filed in 2020 that failed to meet the due diligence requirements, but only for the earned income tax credit, okay? Your penalty that you will owe the Internal Revenue Service will be $26.50, which is the 530 penalty times the 5 returns that the IRS found the failure to meet the due diligence requirements on, okay? $2,650. Just imagine how much preparation fees did you get from those 5 returns, okay? It's not worth it, guys. Also, let's take it a step further. Let's take those same tax returns as in the example before, but they also failed to meet a child credit, the American Opportunity Tax Credit, and the head of household filing status, okay? That penalty increases significantly, $7,950. What? No one wants to pay that. The IRS is not playing games, you all, and you shouldn't either, because they are out here having tax professionals pay these penalties. You do not want to be one of them. So let's prevent that. Let's look at some common errors with the earned income tax credit. And so claiming children who do not meet the relationship or residency test, okay? Look those up to make sure you know what it makes a child eligible as far as relationship, as far as residency, as far as age. Make sure that the child is passing all of those tests. Either over or under reporting income or expenses, particularly on the Schedule C, and of course using the incorrect filing status, because if the appropriate filing status is married filing separate, that taxpayer cannot claim any refundable credit, especially the earned income credit. So you have to know your laws. Let's now take a look at some common errors dealing with the child tax credit, additional child tax credit, and other dependent credit errors. And so either claiming this credit for children who do not meet, again, the relationship or residency requirements, that is very common. Claiming other dependent credit for qualifying relatives who do not meet the member household or relationship test, and claiming other dependent credit for a person with an I-10 who is not a resident of the United States. If anyone who is filing a tax return does not have a social security number and they have an I-10, meaning they're not a resident of the United States, you cannot claim a credit pertaining to this person. Even if they meet every other test, if they do not have a social security number, you cannot claim a credit for them. Let's take a look at some education errors. So claiming a student who didn't attend an eligible college, university, or technical school, eligible being the key word in that sentence, or claiming a student who didn't pay qualifying college expenses. Again, keyword qualifying. Make sure that you know the definitions of those key words such as eligible and qualifying. Also, claiming unqualified expenses, of course, and claiming a student for more than 4 years. The American Opportunity Tax Credit is only good for the first 4 years of a taxpayer's post-secondary education. This means it typically takes 4 years to receive a bachelor. They can claim this credit each of those 4 years. If that taxpayer moves forward to pursue a master's degree that is beyond the 4-year scheme, they can no longer take advantage of the American Opportunity Tax Credit. And so let's look at some common errors dealing with the head of household filing status. So claiming the HOH filing status either when the client does not pay more than half the cost of maintaining a home, or when married filing jointly or married filing separately is the correct filing status. I see that often, okay? If you are married, if your client is married, there are typically two options, except for in certain situations, which you should familiarize yourself with, but there are typically two options of filing status: married filing joint, married filing separately. A lot of married people get in the habit of claiming the head of household filing status. That is incorrect. And so let's jump in a little deeper with the head of household filing status and see what is required to be eligible to claim this filing status. And so your taxpayer must be unmarried or considered unmarried on the last day, keyword considered unmarried, and also must have paid more than half of the cost of keeping up the home for a year. But the biggest one is you have to have a qualifying person live with your client in the home for more than half the year. Essentially, that person, your client, must have a dependent. That is a huge red flag. People claiming the head of household filing status without a dependent. That is the biggest red. That's like beaming to the IRS, like, come get me now, because that's a huge red flag. You don't want to find yourself in that bucket. And so let's dive deeper into what it is to be considered unmarried. So they must file their own return. They must have paid more than half the cost of keeping up their home in the last tax year. And this is the largest one, have not lived with their spouse at any time during the last 6 months of the tax year. Not the first 6 months, but the last 6 months of the tax year have not lived with that spouse. And of course, have a dependent. And so let's take a look at what a qualifying person looks like for your client. If it's a qualifying person includes a qualifying child, okay? Anyone who's under the age of 19 at the end of the year, or was a full-time student at the age of 24, or was permanently and totally disabled, can be a qualifying person. Another qualifying person could be your client's qualifying relative for the other dependent credit. And so ensure that you know what these keywords mean: considered unmarried and qualifying person, and what considers a person, or what qualifies a person to be eligible to claim these filing statuses. And so you want to be aware of these potential filing status problem areas when determining the filing status and your client's eligibility for the credits. And so keep in mind that the Earned Income Tax Credit and the American Opportunity Tax Credit can only be claimed with 4 filing statuses. And that's essentially all of the filing statuses except married filing separate. If the filing status is married filing separate, you cannot receive the Earned Income Tax Credit or the American Opportunity Tax Credit. Keep that in mind. And so let's move on to discuss some tools that you can utilize to help you determine the filing status. And so you can use Publication 501 or Form 886-H-HOH to determine if someone is eligible for the head of household filing status. And so you will want to do this if you have a client saying they're separated, but they qualify for the HOH filing status, or if you have a client that says they should file head of household when they are single, or if they are married. I see that often as well too. And then of course, if you see that there are more than one head of household individuals at the same address, that's a red flag. You should probably ask more questions from your client. Also, letter 5025 is a letter addressed to pay preparers from the Internal Revenue Service who prepare tax returns claiming one or more of the credits, of the refundable credits. And it indicates that the preparer may not have met due diligence requirements. This is a scary letter to receive. It's essentially a warning. And on this letter, it will list the primary issues identified on the tax return and how it affects the pay preparer and as it pertains to the due diligence requirements. It is for informational purposes only, and the Internal Revenue Service will continue to monitor you as a pay preparer in your future returns while claiming these credits. So if you receive this letter, you're already kind of flagged in the IRS's eyes. They're definitely going to be looking at your tax returns a little bit more frequently to ensure that you are meeting the requirements. If you receive this letter and they have determined that you have indeed failed to meet some requirements, then unfortunately you will be penalized at $530 per failure, and we just don't want those type of problems. If we are thinking about a typical tax return preparation fee of someone who receives the earned income credit, that return fee is no more than $300, okay? Maybe four, but $300 prep fee for an error of not of or failure to meet the requirements. It's a $530 penalty, guys. And so you are paying way more than you receive for this particular tax return if you decide to fail to meet these requirements. It's just not worth it. It's not worth it. And so I always want to leave you with something tangible that you can do. And so here are some trainings and research and tools that you can utilize on your journey for yourself and for your team if you have employees. And so for me, the irs.gov website is always the answer. It's the horse's mouth, okay? Just go there, you find out anything and everything you need to know. And so on this website, they actually have a pay prepare due diligence training. Each year, I take it every year, and I will actually make sure that I put these links on the page so you all can click them and go directly to them. But I take this training every year just to make sure I am up to date with all of my due diligence training, and I have my team take this training as well, in addition to all of my partners. There are also free webinars for tax practitioners. Look into that. And of course, Circular 230. If you are a tax professional, you should know exactly what Circular 230 is. If you do not, get familiar with it quick. But it's the regulations governing practicing before the Internal Revenue Service. So it's something that we all need to become familiar with, guys. And so here it is. Go to irs.gov, find out all your answers, follow the due diligence requirements. We do not want to pay any extra fines or fees for something that we know we needed to do, guys. And so due diligence, that is how it affects you. Let's go be great and have a great tax season. This is Tatiani Favors, your tax business coach. Until next week, bye-bye.